Okay, everyone, so I went home and I was looking at this formula up here, okay? So the after-tax cash flow formula when you sell an asset. And it just wasn't making sense to me. I calculated and calculated and calculated, and I couldn't figure it out. Then I realized simple algebra, as I put in your email today. You gotta do, when you're doing a question like this, you have to calculate what's inside all of the brackets first. I wasn't. I was calculating this times this, and then I was adding, I don't know, just because of the way they wrote the formula in the textbook is not a good formula, okay? If you use this formula here, you'll never get the question wrong, okay, when it asks you for an after-tax cash flow, okay? So let's take a look at the example then on page 345. Okay? So it says here that, again, the machinery is going to sell for $2,000. So if the machinery is going to sell for $2,000, that has to be the market value. Okay. Now, what's the book value? Well, it just said here that for FSS's project, this will be depreciated down to $5,000, but only expected to sell for $2,000. I don't like the way they term that. I would have said its net book value is $5,000. Okay, but again, this is a finance textbook. Okay, so the book value then for this asset, again, book value is cost minus your accumulated depreciation. Okay, so in this case here, the book value was $5,000. Now, we've got to figure out what's in the bracket first. So our market value is $2,000. Why is market value $2,000? Well, because ultimately that's what we sold it for. Okay. 1 minus the tax rate, and in this case the tax rate is 0.34. Okay. So again, algebra says we work our way down. 5,000 plus minus 3,000 times, and in this case here, 1 minus 0.34 is 0.66. So again, we're working our way, or we're figuring out what's in the brackets first. Now we'll go 5,000 plus, well, again, what's in these brackets? Minus 3,000 times 0.66. So minus 3,000 times 0.66 is 1,980. So as a result, 5,000, again, plus 8 minus 1980, we can just go minus 1980, and we get 3,020. Okay. Just like what's in the textbook. Again, I don't know why I couldn't, I guess I wasn't seeing proper multiplication there. But that's what you have to do. If you use that formula, you can't go wrong. Okay. Same thing for the example on page 346. Okay. If you would have done it the same way as this here, you get the exact correct answer. Whoa. I'm just going to redo that. So the example on page 346. So a firm has a tax rate of 25%, sells an asset for $4,000. Okay, so the tax rate is 25%. You can fill that in. What they sell it for, that is the market value. So in this case, the market value is $4,000. The book value is, again, what's Well, it tells us here the depreciated book value is $2,000. So that's what we valued on our books at. Okay. So 0.75, 2,000, 2,000. 2,000 times 0.75 on this side is 1,500. Okay. So 2,000 plus the 1,500 gets 3,500 bucks, just like we have in the textbook. Okay. So you're going to want to use this formula when you do problem 12.8. Okay. And also when you get to we also have problem 12.2. So if I flip ahead to problem 12.2, what I'm dealing with is a present value calculation. Okay? So we know we know how to use these formulas. Okay, so going ahead then, it says here with 12.2, estimate the present value of the tax benefits from depreciation. Okay, well now you're going to have to go into a present value calculation, and let's look into that right about now. Okay. So again, I just want us to go to, we're going to start off on page 349. Now again, this textbook is assuming the student does not have a good background of accounting. So we already know what Excel depreciation is, okay? So that's where you have, you might have a normal 20% depreciation rate, but you're speeding it up by an extra 20%. So you're taking 40%, okay, of the always a remaining book value. Now it says MACRS depreciation calculation. We're not going to worry about that because that's an American term. And again, we're just not going to cover that stuff. Okay. So we also have to be aware of the half-year convention. So the CRA dictates that for tax purposes, we can only use the half year. We have to use the half-year rule in the first year of acquisition. Okay, that would come into play if you were calculating your after-tax cash flow, okay, on an asset like this. So it may say you bought the asset for $10,000. You're going to depreciate using double declining balance at 20% a year, calculate it, and then because that would then give you your book value once you've sold the assets. You're working your way down. So you're not always going to be given the book value. You might be given, here's your cost, here's your accumulated depreciation. What do you do with that? Well, that's going to tell you your book value. Or you might have to figure out your depreciation and, again, figure out your own book value. But what we've got to be aware of in this course, the formulas are always built on one another, okay? So if it says, the next question we have, if we go ahead and look at the assigned question I said for problem 12.2, present value of depreciation tax benefits, okay? So it says here, the equipment, we got to buy $1 million worth of equipment, depreciable life 10 years, depreciated to $150,000. So if the cost of capital is 13% and the firm's tax rate is 34%, estimate the present value of the tax benefits from depreciation. Okay, so there, you're going to have to go ahead and you're going to have to look, okay, well, this is kind of made up of two formulas. Okay, so the first thing that we need to do is we're going to need to figure out how much are we going to depreciate. Okay, so in this case here, we're going down to $150,000. Okay, and then if you tie it into the reading LG4, we are going to get a formula that we can use. Okay. So I'm just going to go here. I had it pulled up just to give you a little hint. I'm trying to find it. So I'm just coming up. Hold on. Okay, Okay, so getting back to that. So it says here that cost of capital is 13%. So that's basically, whenever you need to use an interest rate, that's what you would use, again, your cost of capital. So we know our depreciation in this case on a straight line basis would be $85,000 a year. Okay? So they're going to use it for 10 years. Now, the thing with tax shield, okay, is that we have here, we're given a 34% tax rate. Okay? So if a question's asking you, well, what is the savings? How much are we actually going to save? Okay? Well, we're going to save every year 85,000 times 0.34. So 28,900. Okay? So in this case, for problem 12.2, 28,900 is our starting point. Okay? So again, I'm just reading this off the answer key, but with a 34% tax rate, the depreciation will save you $28,900 per year. Okay? Not $85,000 a year, because your tax rate isn't 100%, it's only 34. So when they look at tax savings, you have to take the amount and multiply it by the tax rate. Okay? So now you're getting a tax saving of $28,900 per year. Then what you have to do there is you have to put it into an annuity formula. Okay? Not annuity due, but annuity. Okay? So you already have your after-tax amount. All you got to do now is use the annuity formula. Okay? PVA at 10 years, 13%, and you should be able to get the right answer. Okay, I just want to wrap, so that kind of covers what I've assigned today. Now, going ahead, you'll see some terminologies here. It says Section 179 deduction. Don't worry about that. That's, again, that and the MACR's depreciation calculation, that's an American terminology. But just brush up a little bit on depreciation, okay? And again, you're going to need to know that to be able to do the next question, like I said, 12.2, and then going ahead to try 12.8. Okay, so if you look at 12.8, it says here, now I'm giving you a hint, okay? So with 12.8, what I want you to do is use an accumulated depreciation of, now I wrote it on the assignment, but it's basically your cost minus the ending book value. So the cost on this item was $50,000. Your accumulated depreciation that I want you to use is $46,295. Okay, so you got your cost, you got your accumulated depreciation. That will give you your book value. Okay, why is that important? Well, because at the end of year 3, you're selling it for $5,000, but you got to compare that to your book value so you can do your after-tax cash flow calculation. Okay, and that will give you your after-tax salvage value. Okay, so again, like I said, today's slides were very, very short. Okay, because again, there was more U.S. terminology in here. But again, try problem 12.2 and 12.8. Okay, read ahead, page 349 to 351, and next week we'll get into a little bit more of a detailed question where we're taking all the parts and putting it together to determine if we should go ahead with a project. Okay, because this question is important. Why? Because it's going to contribute to your net cash flows. The only thing is, you're getting this payment at the end of whenever you do your project. Okay, so that's it for today. Have a good weekend because this is the last class for corporate finance, and I will talk to you on Tuesday.